Have you ever wondered how investors make money from buying bonds below their full value? Because sometimes an investment grows not because the market price explodes, but because it slowly moves toward its true value over time. That process is called accretion of discount. Accretion of discount happens when a bond or financial asset is purchased for less than its face value, and its value gradually increases over time until it reaches full value at maturity. In simple terms, the discount slowly disappears over time. Let's break that down. Imagine a bond has a face value of £1,000, but an investor buys it for £900. That means the investor bought the bond at a £100 discount. Now, when the bond eventually matures, the issuer still pays the full £1,000. So the £100 difference becomes additional gain for the investor, but instead of appearing instantly, accounting rules gradually spread that increase across the life of the bond. That gradual increase is called accretion of discount. Now, why would a bond sell below face value in the first place? Usually because interest rates have changed, the bond's coupon rate is lower than newer bonds, or market conditions reduced its current value. But regardless of why it trades at a discount, if the bond reaches maturity normally, its value moves closer and closer to face value over time. Let's make this really simple. Think of it like buying a £100 gift card for £90 today, knowing it will still be worth £100 later. The closer you get to using it, the closer its value moves toward the full amount. Now, how is this handled in accounting? The increase in value is recognized gradually over time as interest income or investment income. This creates a more accurate picture of earnings instead of recognizing the entire gain all at once at maturity. That's important because accounting tries to match income to the periods in which it is earned. Now, why does accretion of discount matter? For investors, it helps measure the true return on discounted investments. For accountants, it ensures financial statements properly reflect the changing value of bonds and other discounted assets. And for businesses, it improves transparency in financial reporting. A common misunderstanding is thinking accretion of discount is the same as market appreciation. It's not. Market appreciation depends on changing demand and prices. Accretion of discount is usually a structured increase tied to a fixed maturity value. Another misconception is thinking the gain only exists at the end. In reality, the value is gradually increasing the entire time. So, what's the key takeaway? Accretion of discount is the gradual increase in the value of a discounted bond or financial asset as it moves toward full face value over time. It spreads investment gains steadily across the life of the asset instead of recognizing everything at once. And once you understand accretion of discount, you begin to see how some investments quietly grow, not through hype, but through time itself.